A little bit about Tidemark, California. As an office, we offer over 50 years of combined experience, especially in providing retirement planning and investment management services. And, really, I think retirement planning is such a hot topic right now because, we have the baby boomer generation that is there, everything that's starting to go on. And of course, the investment management side is, as today kind of showed us with the market, is there's a lot of volatility, and making sure that you have the right strategy in place and really taking control of your retirement plan is extremely important. And so, really our specialty is with those people that are, 5, 10, 15 years away from retirement, looking at what they need to do in order to do that. Some of the other areas that we focus on is a lot of educational workshop and seminars. But really where we have the biggest impact is that, those personal appointments, that one-on-one to answer the questions that everybody has, and not necessarily in a group. So a little bit about today's agenda, or tonight's agenda. I think it's, obviously we're all here because we want to talk about retirement, but I look at it from the retirement red zone. So, really what that is, I'm a big sports fan, love the NFL and football. Hopefully we have it soon. But it's when you're inside that 20-yard line. And, anybody that's joining us tonight is in that 20-yard line that is making sure they're running the right plays to be able to score that touchdown. And, really some of the key areas that we're going to talk about tonight is, one, budgeting for your retirement. Hopefully everybody today has some type of budget already in place that they're going off of right now. But they also need to remember that they need to have a budget for retirement. Once we understand that, now the question starts to become, where is our retirement income going to come from? Where's the sources? Well, how much are we going to get? At what age should we start taking these different sources of income? Next is the current portfolio review. Especially in today's market, it's important to understand the investments that you're in and the risk that is associated with those investments. And last but not least, Frank's really going to talk to us tonight about what are some different strategies that people can do right now in today's market. A lot of people want to sit back and they just don't know where to go. And so we're going to give you 4 different strategies to talk about and that you could potentially look at implementing for your own retirement plan. So let's talk about budgeting a little bit. Budgeting is, I think for a lot of couples, one of the most difficult things to talk about because people just don't want to know where they're spending their money. And, it's important to understand when you get to retirement, what type of income am I going to have to replace and where's that money going to come from? And so, this study shows from Fidelity, shows the different income levels, $50, $100, $200, and $300,000. And where is that money going to come from? Either your savings or Social Security. And realistically, what is the percentage of money that you're going to be having to replace? So you can see from the stats, if you're living off of about $50,000 today, when you get to retirement, 45% of that is going to come from your savings. So these are things like your 401k, IRAs, and any investments outside of retirement accounts. And 35% is going to come from Social Security. And I think the big takeaway I want you guys to understand is you can see as your income is higher, the amount from Social Security that you're going to get is going to become less from a percentage standpoint. So if you're in that state where you're around, wanting to live off of about $200,000, really you're going to have to replace about 61% of your total income. Only 16 is going to come from Social Security. The other 45 is going to come from your other assets that you have. So when it comes to budgeting, the question becomes, what can I do right now? And, really, if you're in that retirement red zone and you're getting, within the 5-yard line, I'll call it, 12 months or even 24 months away from actually getting to retirement, look at what you feel like you're able to live off of when you do there. We meet with a lot of clients and a lot of prospects, and they always tell us, yeah, I can live off of $100,000 when I get to retirement, but they may make $200,000 today. And, it's really starting to put in that practice. If you think you can live off of 100, try to live off of $100,000 today then and see how that does. That will really tell you if that is a realistic expectation. And, when we're going through the retirement budget for people, we break it up into 2 spots. One is going to be your fixed expenses. So everybody hopefully knows what a fixed expense is. It's everything. It's something that you're going to need day in and day out. It could be a mortgage payment or rent payments. It could be the food that you need to put on your table for you and your spouse or you and your family. It's going to be a car to get you from point A to point B. Now, it doesn't necessarily need to be the nicest car, but it's expenses that you're going to have day in and day out. Once we understand what those fixed expenses are, then we can start looking at our wants or our variable expenses. You know, I want to go on 2 to 3 vacations a year. I want to be able to golf once a week. These are things that we don't necessarily need day in and day out, but it's stuff that we're going to want to be able to do to enjoy life. What fun is retirement is if we can't enjoy life. And so, you know, what we want to look at from that standpoint is to understand, where are you, right? How much money am I going to need from retirement? And, you know, where is the income eventually going to come from? And, you know, really when you're looking at retirement as far as from an income generation standpoint, think about it like the stool that's on this picture. It's going to come from 3 different sources. And even right now, I'll kind of jokingly say, really, we have about 2.5 legs, because pensions, which are, you know, were a huge majority of somebody's retirement back in the day, is starting to go away. Even if your current employer offers you a pension right now, there's a very good chance that eventually you're going to get a piece of mail that is asking to buy you out. The reason for it is because pensions are expensive for companies. And so now it's becoming more driven behind the other 2 legs of Social Security, and eventually it's put into your hands with the investment management or investment assets. This is going to be your IRAs, your 401ks, and your non-qualified money, so money that is outside of retirement. So just to kind of go through this really quick again, you know, your fixed assets are where you're going to get that monthly paycheck that necessarily isn't going to fluctuate because of what's happening in the market. It's going to come from your pension and your Social Security. They're not tied to your actual assets. Your variable expenses, though, you know, the golf, the going out to dinner, the travel, all those different things that you want to be able to go do, that's going to come from all of the other assets that you have. Is it your Roth IRA to have tax-free money? Is it your traditional IRAs, your consolidation from all your old retirement accounts, your 401k plan, or eventually, you know, or also having any type of stock options through your employer, or having just wealth outside of retirement accounts. And, you know, being able to determine, all right, what percentage of these assets are coming from this, from our fixed versus our variable, is extremely important. And so what I want to go through with you is just to kind of give you a quick breakdown as far as when we're sitting down in front of a client and talking about, all right, here's what your retirement picture is going to look like. This is one of the important graphs that we like to show them, because it gives them an idea of, all right, in the first couple of years, we're going to be living off of about a 50-50 split between either a pension or Social Security and our variable assets. But then this also starts to give us strategies on how we can maximize Social Security. And, you know, everybody knows that Social Security can start at 62 is the earliest you can start drawing at it. But then they always think that, hey, 65 is this magical number, which really 65 is a magical number for Medicare. It's not necessarily a magical number for Social Security. And so what we want to look at from our side is, how can we maximize Social Security to make sure that our retirement plan is as efficient as possible. And, you know, it's once again taking in the spouse, taking in their assets, their income, their Social Security, putting everything together and putting together a picture. So you can see here with this, you know, with this client that we were working with, for the first 6 years, they weren't drawing any Social Security. They were just drawing off a fixed pension, which was that green part. And then we started to maximize their assets to make sure that they'd be able to do this, maximize their Social Security. Then we were able to turn on Social Security at age 70, or the plan is at least to turn it on at age 70. So now they're maximizing their Social Security, and now we don't have to worry about taking a large percentage withdrawal of their assets until one of the spouses die, which is shown towards the end of that graph, right? So that pension is now gone because the husband or wife passed away, and now they're having to significantly draw assets out to make up for that lifestyle that was there. How do we gauge or grade how successful that plan is that we were just showing you? Is, you know, one of the big ways that we look at it is through the Monte Carlo simulation. And if individuals don't know what the Monte Carlo simulation is, Basically what this does is it takes 1,000 different market scenarios from the best to the worst case to the middle and tells us what is the likelihood that our retirement plan is actually gonna succeed. And just like back in the old days of high school and college, what this does is it gives us a percentage of being fully funded. And so once again, I go back to this couple that we were talking about, and we ran all these different market scenarios, and it showed us that they're 77% of the time, they're fully funded for retirement. And so, this either gives people peace of mind, or it tells them like, hey, there may be some things that I need to change. Is it that I need to work longer? Is it that I need to live off of less money? Do I need to save more? What are the different things that need to be changed today to impact that retirement plan for somebody? And so once again, the Monte Carlo, I think it's a great way to think of it is, you're on Tidemark Financial airplane, we're going to your retirement destination, and I get on the loudspeaker and I say, ladies and gentlemen, thank you for flying with us. There's a 63% chance of getting to your destination. Would you still get on our airplane? Or would you start to make questions and want to know what changes you can make to make that number higher, right? I mean, in the perfect world, we want it to be 100%. And with the right work and depending on where you start, you can eventually get to potentially that 100%, or at least that higher percentage that's there. And so the Monte Carlo is a great place to actually test what you're doing. How does this all play into, we're talking about best case scenario, worst case, moderate. I look at Ray Dalio, who in my opinion is one of the top 3 best investors that's out there. And, a lot of it is through asset allocation. And he comes out and says, I think that the first thing is you should have a strategic asset allocation mix that assumes that you don't know what the future is going to hold. And I think, the reason I put this quote in there is because today's market, especially today and the last 3 months, it does have a significant impact from asset allocation because, at the end of 2019 into the beginning of 2020, you look at the economic factors, you look at the stock market, things were going along smoothly. And nobody that I know of knew that COVID-19 and that some of the other things that were going to happen where a country was going to come to an economic stop was going to take place. And asset allocation can help people not necessarily protect against loss, but it can help burden the losses that can potentially take place. And so what do we do for clients? How do we look at it from a standpoint? And really the areas that we look at it is we want to stress test and we want to grade, once again, what our portfolio is and what type of risk are our clients exposed to. And we go back to this, the client that we ran for the Monte Carlo simulation, and we started looking at their portfolios that were outside of the LPL accounts that were holding with us. And we're having the conversation. We always like to ask if, what do you think? Is your portfolio aggressive, moderate, conservative? How much risk do you think you're exposed to? And when we were talking to them, they came and said, our personal trust is probably our most conservative position. Well, we started to go through the different investments that they were invested in. And it actually turned out that this was the most aggressive holding that they had for all of their assets. And we want to make sure that we have a purpose for our money and the time frame that we're going to need this money. And maybe, being extremely aggressive for your personal trust because you may need that money in the next couple of years isn't the right choice. Now, everybody has a different risk tolerance, and even husbands and wives and spouses, they have different risk tolerances, but we want to make sure that we understand what risk you're exposed to as we're going through investing, because that helps with panic selling. We don't want to panic sell if the market's going down, because we need to understand what we're actually invested to. And having this risk score, I think, is extremely important. We can't tell necessarily what future performance is actually going to do. And so what we want to look at is what is historically done and what would my accounts have done with my current allocation. And then also, if I start either increasing risk or taking risk off the table, what would my accounts do at that standpoint? And really, I think the two that stand out here is either the 2008 bear market, which was, the entire 2008 year, or even the Great Recession, which was October 15th of 2007 to March 2nd of 2009. And that gives us an idea of what risk does and how it goes through and what is our performance, what would our performance have actually been. And, once again, everybody has a different risk tolerance. So it's finding that right match for what's actually there for those individuals. And, once again, go back to Ray Dalio, asset allocation is key when we're talking about risk. And it's a key when we're talking about stress testing a portfolio. Now, all that stuff that we went through is fantastic. And, we talk about what we do for our clients and how we work for them. But, the reason that everybody is here tonight is to talk about what are strategies that I can do right now to take action on? What are the things that I can do to make sure that, hey, if I'm behind in retirement, what can I go through and do? Or how do I eventually take control of your retirement plan to get you to be able to be more involved with what you're doing? And so, once again, I want to introduce Frank to, joining us tonight. He's going to walk through these 4 strategies that we're going to talk to you about. And we're really going to start to dig into some of them and answer some questions. So Frank, thank you for joining us tonight. I appreciate it.
Thank you so much, Josh. And I want to tell the audience 2 things, right? The first thing is we're accepting questions. So if you want to send us your questions to info@tidemarkfp.com, we'll be sure that we read some. And there's going to be a section here on the presentation that we're going to go over those. And secondly is that we're offering an incentive. You made it so far. So towards the end, we'll be talking about that. So once again, for everybody who doesn't know me, my name is Frank Alvarez, and I'm a financial consultant here at Tidemark Financial Partners. And first and foremost, I hope that everybody's well, everybody's staying safe. And quite frankly, we've been going through unprecedented times. And really the reason why Josh and I started this webinar is because our office was constantly getting calls from people asking themselves, what can I do right now? They started seeing this increase in market volatility where they saw their accounts drop down 5, 6, 10% on a daily basis. And quite frankly, today being June 11th, it kind of brought us back a little bit to those times that we started seeing the health crisis. We started seeing our personal accounts. We started hearing stories. And either 2 feelings that came to mind. One was, what can I do right now? And second is my family going to be okay? So we're going to be talking about the 4 strategies that Josh and I came up with. During the midst of the pandemic, we sat down and we came up with 4 things that we have been utilizing with clients to help them prepare for retirement in this market. So let's go ahead and get started here. And let's see real quick. So what can I do right now? So I think Josh did a fantastic job, right? This is going to be the 4 things we're going to be talking about this night. And the first thing is going to be reviewing your current asset allocation. So as mentioned, right, I think Josh did a fantastic job with this one. And I want to emphasize something real quick here. Really the importance about having a financial plan. We see so many people go through insecurities and not being able to sleep at night because they don't know where they're currently standing. They see their accounts dropping, they see the volatility of the market, and they start getting pretty preoccupied with, am I going to be able to one day stop retirement? Or even for our retiree clients, are we going to be able to keep on maintaining the same lifestyle while we're looking at our accounts drop on a daily basis? So by having this written financial plan in front of you, I can't stress enough how much peace of mind does that give you, knowing that you are on the right track, hopefully, knowing how much you need to start increasing your savings, but also testing it out, doing that Monte Carlo analysis simulation, doing those stress tests to know that we're getting closer to a higher probability of success, and that should give you that peace of mind. Second thing I want to talk about that we're going to talk about this night is going to be taking control over your assets. And this is going to come in 2 different categories. Really the first category that we're going to talk about is going to be account consolidation. Why do we want to talk about this? Really because we found out from prospective clients that come and sit down with us that multiple people, and really I want to bring in a quick research here. The average person works anywhere between 5 and 7 different, changes job 5 to 7 different times throughout their lifetime before getting to retirement. But what we also find out here is that a lot of people do open up 401k accounts with every employer, really like they should. But once they leave that employer, that retirement plan stays behind. And for us to be able to go back and really track how many assets are in each plan, what's the asset allocation that you currently have, what's even the passwords that you have, it starts to become quite complicated. But what also a lot of people don't know is that we have options for this. And this is something that we've been helping a lot of clients do to, once again, to bring in that clarity and that peace of mind, which is just consolidating all our accounts. And really to talk briefly about this, 401k plans and traditional IRAs are considered tax deferred accounts. So a quick solution is what we can do is we can grab tax deferred account A, let's call it X employer 401k. We can grab tax deferred account B, let's call it Y employer 401k Z, and we can transfer those assets into the traditional IRA. Now, by doing so, there's no penalty and there's no taxes associated with it because we're going from tax deferred to tax deferred. And really having everything in one house is just going to bring that clarity of knowing that one password, knowing exactly what percentage we have in each category, and it's just going to make our lives a lot easier. It's funny because I remember this prospective client, now a client of ours, that came to our office and said, I think I have a pretty diversified portfolio. I have a 401k with Fidelity. I have a 401k with Vanguard. I have a traditional IRA with T. Rowe Price. And we came out saying, well, that's great that you have this different pockets of assets everywhere. However, that's not true diversification. It was really just choosing whatever it was performing well, not too much looking at the assets overall. So really what we came out to do was said, okay, let's see how much money you have in each category, combine it all, and then we can actually start doing that asset allocation. So once again, that's why account consolidation is very important. When market volatility spikes and people want to be making changes, we don't want to be logging into different accounts. And that's why I wanted to emphasize that. Second thing I want to talk within this subset of categories of taking control of your assets is what we call an in-service withdrawal. What a lot of people don't know is that you can take control over your 401k while still working. You can take out that 401k if that's something that is going to be beneficial for you while you're still working. However, there's going to be some restrictions that we're actually going to cover a little bit more in detail. The third thing that we're going to talk about this evening is going to be your tax loss harvesting strategy, which is going to be how can we take advantage of the volatility this market has brought to help us within our taxes. Lastly, we're going to talk about Roth conversion strategy, which is how can we increase our tax-free income during retirement when the markets are going through a recession or bear market periods. So let's go ahead and get started. Let's talk a little bit more about in-service withdrawals since we were talking about the topics of retirement accounts. So what is an in-service withdrawal, right? So quite simply, it is going to be a distribution that a participant takes from a retirement plan while they're still working, as we mentioned. What are the restrictions, or are there any restrictions as to when a participant can take an in-service distribution? Yes, there are. Mainly, there's going to be age. But the restrictions are going to vary based upon the account source, meaning if it's going to be an employee deferral account, a profit sharing, a 401k, IRA, etc. So those restrictions are generally based on factors such as age and service. And really to find out, every plan provider works a little bit different. So this is something that I would consult with your HR department or even your plan provider to see if this is going to be something that is going to be allowed. What I want to talk about here too as well is that you might want to leave some money behind the 401k. That's completely okay. What you can do too as well is you can do a partial withdrawal or a full withdrawal within your 401k if the plan participant allows to, and also if you meet this next category we're going to talk about, right? So what is the significance of age 59 and a half when it comes to an in-service distribution? You probably have heard this age 59 and a half before, and really the significance of it is that that is the earliest age that the law allows a participant to take an in-service distribution from his or her 401k deferral account. Coincidentally happens that age 59 and a half is also the age at which the 10% early withdrawal penalty no longer applies. So I want to talk briefly about a quick example right now that we've been helping some clients do. And I can remember a quick story. So we have a client that we've been working with. He's been working, and remember I mentioned within the statistical quote that said that the average person works 5 to 7 different jobs throughout their lifetime. Well, this particular client of ours, he works at one of the major engineering companies here in San Diego. He's been working at the same company for 30 years. He accumulated a quite significant amount of money within his 401k. Coincidentally, also ends up happening that he just turned 60 this year. And amidst the whole pandemic scandal, everything that was going on back in February, him and his wife started getting pretty preoccupied within the status of their market. So we were going over his current asset allocation, and what we found out is within the 401k plans, traditionally there's only anywhere between 10 and 15 mutual funds in there. Some of the investments might be good, but some of the investments might not be as good. And for a pre-retiree, he's looking to retire in the next year or two. For a pre-retiree, we only find out that there's only 2 bond portfolios, which are going to be pretty general bond portfolios. Now, if you know anything about asset allocation, you know that each type of bond category like acts differently according to interest rates and everything that comes along with it. So we want to make sure that we have better control over what bonds do we own, but also to give us a better array and a different investments that we can start allocating this client with. Unfortunately, that 401k did not offer that. So this is where that in-service distribution came into play. We were able to withdraw those assets, transfer them to the tax-deferred account, a traditional IRA. IRA stands for individual retirement account. Now it means that that money now is registered under his name. What it also did is it opened up the platform to start looking at every investment out there. So it really gave us a chance to properly diversify the portfolio for the client in the most efficient way possible, while also tangling it with his financial plan. So we were able to make some changes, and that's, once again, that's the importance about this strategy in service withdrawal. It does give you a better choices within what's in your 401k, and if you're not happy with that, we can definitely do something with it. I'm going to show you a quick example here and what it looks like. And once again, as I mentioned, each plan provider is going to be different. This was from a Fidelity 401k plan. This is what it looked online. We were trying to do a partial withdrawal from a 401k for another client, and we showed that there was only $18,867 that we were going to pull out. It gave us a couple of timing, how far is he going to get that check? But I want to emphasize something here real quick. Make sure that you talk to a tax professional or a financial professional like ourselves before performing this, because there's a lot of different rules and stipulations within this strategy that you want to make sure you're doing the right thing. So next thing, since we're talking about 401k accounts and retirement accounts, I want to talk a little bit about this strategy that we really like for some of our clients, which is going to be the Roth conversion strategy. For some of the people who don't know what a Roth IRA is, it's simply what we call a post-tax account. The real benefit of this is that you don't get any, really the con, right, is that you don't get any benefit for contributing right now, tax-wise. But the real reason why we choose Roth IRAs is that any growth that we experience here is going to be tax-free, right? So with that said, let's imagine this. During this increase in market volatility, what we can do that a lot of people don't know is we can transfer some of that 401k, some of that traditional IRA money, and convert it into a Roth IRA. So really the big advantage here is that, let's say, for example, to give a quick example, let's say we buy Coca-Cola shares and hypothetically they're at $100 a share, but we like them, right? And it's a solid company and we feel that it's gonna go back up again. During market volatility, let's say Coca-Cola drops from $100 to $50, right? Now we're converting that money, those $50 into the Roth IRA. And now when the market recovers and hopefully gets back to $100, now we're getting that $50 gain completely tax-free. All right, so once again, to read a little bit over here of the slide, it has the potential to transfer assets at a lower value, just like we talk about in this example of Coca-Cola, from the pre-tax account to a post-tax account. What I want to talk about here is by doing this conversion once again, and you're going to hear me repeat this over and over, talk to a financial advisor or a tax professional before attempting this, because by doing this distribution, this conversion, we're realizing, it's triggering ordinary income taxes, right? But really the benefit that we want to do here is capture that growth in a tax-free manner. And really, who likes paying taxes, right? So what it also, the Roth conversion benefits is going to be the potential to reduce RMDs. So for everybody who doesn't know, or they're still not at the age of taking RMDs, RMDs are required minimum distributions. Basically, what it means is that age 72, by law, you're required to take a certain percentage of your tax deferred accounts on an annual basis, right? Some people don't need to be taking all that percentage that is required. However, because we're taking it out of pre-tax tax deferred accounts, we're liable to pay those taxes. Guess what? A Roth IRA is not required for you to take RMD distributions. So by us converting on an annual basis a portion of that pre-tax money, we are ensuring that your RMDs are going to be drastically reduced. Josh, anything you want to add here?
I think that with Roth conversions and in-service withdrawals and account consolidation, once again, these may not be for everybody, but it's something to at least have the conversation of, and understanding what it is that you actually can potentially do to get that. And I think, especially with the Roth conversion, as Frank was mentioning, you want to look at the tax implication that it's going to do, because if you're converting a large portion of a traditional IRA into a Roth, is that going to potentially kick you up into another tax bracket? What is the tax ramification from doing that? And ultimately is understanding, what is your break-even point, right? If your break-even point is 10, 15, 20 years from now, it probably doesn't make sense to do the conversion. But if it break-even is, you're set up for retirement correctly, and we go back to the Monte Carlo and your number is good, then it could start to do it. It's also a great estate planning tool, I think, that people really don't know about. When they look at estate planning, they look at these other things, they just think about beneficiaries and life insurance and trust and all that stuff. But looking at a Roth conversion, especially if you have a large asset that's in a 401k or traditional IRA, it's a great way to start planning to be able to make sure that you can, one, not have to take out as much of a requirement in distribution, but two is then having that access for tax-free money if you do need it. All these strategies are great. And, I go back to the stool analogy of the three different pillars. And, we've focused a lot now on retirement accounts, 401ks, Roth IRAs, traditional IRAs. One of the, I'd say, most underutilized investment account that's out there is having assets outside of retirement accounts. So if it's through, your company may have some type of stock plan, if you have just built up wealth throughout outside of it, if you sold a house and you had some equity, or whatever the case is, what can people do right now, especially in this volatile market? I mean, you look at today, we referenced it a couple times, the Dow Jones and the S&P 500 were both down over 6%. What are some strategies that people can do, or what is a strategy that somebody can do outside of their retirement accounts? Because I can buy and sell funds in my IRAs and it's not triggering any taxation. So I'm not getting any benefit potentially by either having capital gains or capital losses. And so, the next thing that we really want to focus on here, and Frank's going to go over, is what's called tax loss harvesting.
Correct. And what I want to talk about here is, like we mentioned, we've talked about tax deferred accounts. We talked about those tax-free accounts with Roth IRA, and really what I focus on with clients, and what I like to tell them is, we like them to have what we call a tax efficiency triangle. So if you think about it, a triangle has three different corners. For us to have a tax effective retirement, it would be ideal if you have the three different corners. So what's in each corner, right? One of the corners is going to be a tax deferred, let's call it bucket, right? The tax deferred corner. In the tax-deferred, we're going to have those 401ks, those traditional IRAs, any SEP IRAs, defined benefit accounts, etc., that we briefly been talking about. On the second corner, we want to have our tax-free money, which is going to be your municipal bonds we're buying, which is going to be the Roth IRA accounts, which hopefully they're not going to be tax-free. And then we also want to have our taxable bucket. Each different corner of this triangle is going to be treated different with taxes. So it really gives us a chance to commingle between the three different types of taxation to come up with something that is really efficient for you. So now we're going to talk about this last corner of that tax efficiency triangle, which is going to be a strategy that we want to talk about, which is tax loss harvesting. So basically what it means is that investment losses within this account can help you reduce taxes by offsetting any gains or income. What we want to make sure is that even if you don't have any gains in this account, there are benefits to harvesting losses now, since they can be used to offset income or future gains. So what do we mean by harvesting losses? So we're simply following IRS guidelines in which it says, if you have a set investment and that investment appreciates in value and you sell it, now you made money, now you give me some money, right? Uncle Sam says you make money, I want a portion of it. But also the IRS, what it says is if there's an investment that you have and it depreciates some value and we realize it, meaning we get to sell that investment, now we're having a loss and the IRS can treat that as a tax deductible event. So once again, during volatile markets, during recessionary periods, during bear markets, it's a perfect chance for us to rebalance our portfolios. Obviously, if you're gonna have a diversified portfolio, and I like to tell this, really, if you have a portfolio that every single day, every sector makes money, then your portfolio is not diversified. Really having a diversified portfolio is knowing that you have different sectors that act very differently to where the market is and what sector of the market is improving or not. So with that said, obviously there's gonna be some winners and some losers. What we can start doing with tax loss harvesting is taking care of those assets that haven't been performing well and replacing them with other type of investments within the same category. Realizing this is gonna give us that nice tax break to offset any of the gains from our winners. But if we don't even have any winners, then it's gonna help us carry over that into an ordinary income taxes, right? So if you have more capital losses than gains, you can use up to $3,000 a year to offset ordinary income on federal income taxes. But also, if there's more than $3,000, we can carry over that loss for the rest of future years. So, Josh, anything you want to add here?
I mean, I just think that, not having a plan is not the plan you should have. And, if you haven't had a chance to build up assets outside of your retirement accounts, this is a reason on a strategy on why people should accumulate wealth outside of just retirement accounts. You look at the amount of wealth that is in the 401k and in the IRA market. There's a lot of wealth in the non-qualified or the non-retirement side. And people don't understand necessarily what are the advantages, also what are some of the disadvantages of having money outside of this.
Yeah, and I want to add here, you just had a meeting with an individual business owner that he reached out and said, you know what, I'm maxing out my 401k on an annual basis. I'm maxing out the Roth IRAs for me and my spouse. However, I have a large amount of money just sitting in my checkings account because quite frankly, I don't know what to do with it. Right? What really is interesting is that a lot of people treat their retirement accounts as investable accounts, which is perfectly fine with us. They're playing within the market, they're putting their money there, and they're seeing the growth year over year. However, people are not treating their cash the same way. They just let it accumulate, when in reality, all the money or all the cash that most people should have in cash is 3 to 6 months of expenses. Right? If we have that emergency bucket and we have the ability to keep on saving money, then that money should also be working for you the same way that retirement accounts are working for you.
Yeah, and I think it doesn't matter if it's a retirement account or not, having a purpose for that money is important. Frank mentioned having that 3 to 6 months of an emergency fund. But if you're using the money in 12 or 18 months, it's going to go with different types of investments that are out there. And, once again, it's tax loss harvesting, I think, is important, but overall financial planning is extremely important as well. And, the strategies that we have gone through tonight, once again, they may not be for everybody. You may take one, you may take two, but at least now you know what you can potentially do that's out there. So great. I think it's a great point, Frank.
Perfect. So Josh, I do have a couple of questions here from people. They've been sending us a couple of emails. So the first question they said is, do I need to be 59 and a half to do a Roth conversion?
No, I think the Roth conversion, I think there's a couple misconceptions or unknown facts that are out there. You can do a Roth conversion at any point. So if you're in your mid 30s, your mid 40s, your mid 50s, and you want to start taking advantage of at least looking at a conversion to do it, you have that option to actually go through and take advantage of that. The other misconception, once again, let's take it with the Roth IRAs. There's income limitations, right? If you make over X amount, if you're single or married, you can't add to the Roth IRA. That is sometimes a reason on why a conversion does make sense.
Yeah.
Is there are no income limitations as far as when you can go through and how much of a conversion you can do, right? Remember, if you're underneath the age of 50, you could add $6,500. If you're over the age of 50, you can add an extra $1,000.
Correct.
Well, you can convert as much as you want within the Roth IRA. The only thing to remember is that it is going to increase your taxable income for that year. The other important thing I want to make sure that people understand is when you're doing a Roth conversion, if you do have a pre-tax IRA that's already there, that's something to start taking it to look at. Now, there are backdoor Roth IRAs and other strategies that you can go through and do. It's a little bit more complex than for what we have time.
But we can do a whole webinar on those.
Exactly. How to build up tax-free money for yourself. I think we should do another webinar on just that.
Correct. And I mean, we just try to explain briefly the different strategies. As I mentioned, there's a lot of different bylaws within them, and there's a lot of different taxation. So that's why we encourage everybody to consult with your financial professional or with your tax professional too as well, and see if this is something that is going to benefit you. So I have here the second question. Now we're only going to take this question here, which says, Josh, can I consolidate my spouse's and my retirement accounts?
So remember what IRA stands for, right? Individual retirement account. So it means that it's meant for one person. As much as we all love our spouses, we'd love to combine our money. It's unfortunately not possible because it's tied to each individual Social Security number. Now, when we do look at retirement planning, one of the big things that we focus on is understanding what either the individual or the couple, what their goals are, and treating the IRAs as one IRA when we look at it from that standpoint. Also, that plays a factor in that, though, is the age, right? Yeah. If one spouse is older than the other spouse, maybe we do different strategies based upon that. Maybe the Roth conversion for the younger spouse makes more sense versus just start taking out the requirement distribution for the older spouse. So, correct. No, to long-winded answer, no, you can't combine your spouse's IRAs together.
Just remember, IRA individual retirement accounts. It's a single one person individual, right? So
yeah, exactly.
Fantastic. So how can Tidemark Financial help you right now? So we've talked about those 4 different strategies. Josh talked about the Monte Carlo simulation, those retirement plans. So really where we come in, as we mentioned, we do a great job on a one-on-one basis because we get to know you and your significant other on a personal level. And we also get to see what are your goals, what are your wants. So really performing, where we come into play is by performing an analysis of your current portfolio holdings and walk you through recommendations on your current investment accounts. We can help you understand those strategies that we talked today, but also where is it that you are today in regards to your retirement or create that retirement plan for you. We can help you pinpoint and see where do you fall within the Monte Carlo analysis and see what is it that you currently have done. We would consolidate and implement a strategy on how and what retirement would look like, along with creating different withdrawal strategies for your retirement accounts. This is where Josh was talking about. If your spouse is a certain age, if you're a certain age, like all these different variables, we can help you map that out. But lastly, we would love to give you a second opinion on what have you done already. Probably you're doing a great job, which I'm quite sure you have. But we can definitely help you create that second opinion and see where we can help, right? So once again, thank you so much for attending. And we promised we were going to give a giveaway. So Josh and I are very thankful you guys were here with us this evening. I know we covered a lot of different topics that we're quite simply not able to cover the 4 of them within an hour. So as a big thank you, we're opening up, Josh and I, 15 spots in our calendar. This is going to be during the next 2 weeks. And because you attended this webinar and you gave us a little bit of your time this evening, we're going to be performing complimentary retirement analysis, that Monte Carlo simulation, as long as performing a stress test of your current investments. But this is only going to be for the first 15 attendees to schedule a consultation. We usually charge $2,500 to perform an analysis like this. Now, initial consultations are always complimentary. However, if we're performing something like this is where we do charge that $2,500. But for the first 15 people, as we mentioned, we're opening up our calendar. If you're interested, simply send us an email to info@tidemarkfp.com. And in the subject, put in retirement consultation so we know that it came from this webinar. Put in your name, phone number, an email address, and we'll be happy to schedule that for you. Also, if you're interested in future webinars that we're putting on pretty often, and if you would like a copy of this presentation that we just give, simply also send us an email and put in the subject, I would like a copy, sign me up to the newsletter. We'll be happy to keep in contact with you. And once again, I really want to thank you for having me here, Josh, and thank you for everybody that was here in the webinar.
Thanks, Frank. So, we got a lot of great tools and a lot of great articles and blogs that we've done. Visit our website, tidemarkfp.com. Use this as a resource. And like I said, even if you want to get that financial checkup, you want to get that second opinion, we're definitely willing to help people out. So we want to thank everybody for joining us tonight, giving us your time. It's been, right around a little bit less than an hour. So it's been very thankful. Hopefully everybody stays healthy and stay safe that's out there. So we appreciate you guys. Have a great evening.
Bye now.
Bye, guys.